Hey everyone, welcome to This Explainer. Today, we're diving into a really fascinating anonymous expert report that breaks down the exact legal architecture you need to transfer personal property into a limited liability company. And look, we're not just going to skim the surface here or give you generic cookie-cutter advice. Instead, we're prioritizing the strict structural integrity, those hidden cause and effect relationships, and the non-obvious details of property deeding. Because honestly, that's exactly what separates amateur asset management from expert-level legal shielding. Let's dig right in.
You know, acquiring an asset is really just step one. I mean, anyone can buy a piece of property, right? The real flex, the true mark of sophisticated management, is actually protecting it from lawsuits and liabilities. The legal reality is that an unshielded asset acts like a massive liability anchor. If you aren't legally shielding that property from litigation and systemic financial friction, you aren't actually protecting your wealth at all. You're just leaving your personal balance sheet totally exposed. Think about it mechanically for a second. Every single day a property sits in your personal name, any accident or legal dispute is a direct threat to your savings, your primary residence, your future income, the whole shebang. It's just a fundamental structural flaw. So, to deeply understand how this system actually works, here is our agenda. We're going to cover 4 critical areas: the mechanics of asset shielding, institutional friction points, the architecture of the transfer, and finally, preserving the corporate veil. All right, Section 1, Mechanics of Asset Shielding. Let's explore how the legal segregation of liabilities functions at a purely foundational level. Let's look at the exact mechanism of limited liability. When you move a deed into an LLC, you are effectively severing your personal wealth, your home, your bank accounts, your cars, from external tenant-related liabilities. It's like creating a hermetic seal. If a catastrophic incident happens on a rental property, the legal blow is structurally confined right there within the business entity. It protects your personal stuff from property-specific litigation. A lawsuit basically hits the barrier of the LLC and just stops, legally isolating the financial damage to only the specific asset owned by that company. But here's the catch. Building that shield requires a rigorous baseline. You absolutely cannot just register a business name online, pay a quick fee, and call it a day. No way. Drafting a formal operating agreement is an absolute non-negotiable requirement. Why? Because this signals to regulatory bodies and courts that your entity is fully functioning with distinct ownership rules and its very own tax identification number. And by the way, this rule rigorously applies even to single-member structures. You have to prove the LLC isn't just some empty paper placeholder. It establishes the legal architecture, proving the entity has a distinct, governed existence totally separate from you as an individual. Moving on to Section 2, Institutional Friction Points. Now we need to look outside the LLC to analyze the systemic hazards introduced by banks and insurance carriers. Okay, this brings us to a massive, totally non-obvious hazard: the due on sale clause. If you have an existing mortgage, deeding a property directly from your personal name to your LLC actually triggers this exact provision. Because the ownership profile has legally changed, your lender has the contractual right to demand immediate, full repayment of the entire loan balance. Boom, just like that. Banks use this as a risk management tool because, well, they loaned the money to you, not to your new company. Now, while they don't accelerate the loan every single time, ignoring the structural reality means you are absorbing an immense and frankly unnecessary financial risk. So, how do we actually mitigate this friction with institutional lenders? Well, you've got to be proactive. First things first, meticulously review your loan documentation. You can actually seek written permission from the lender prior to the transfer. This essentially gets the bank's blessing completely on the record. If that doesn't work, you might need to look into commercial refinancing directly into the LLC's name, basically replacing your old personal debt with brand new corporate debt. The implicit assumption that banks just won't notice an unapproved title transfer? Yeah, that's incredibly dangerous and can lead to sudden, accelerated debt collection. Not a fun surprise.
Now let's talk about a fatal structural error made almost universally regarding insurance. People just implicitly assume their existing personal policy is going to cover their newly LLC-owned asset. But if the named insured on the policy is you as an individual and the deed is held by the LLC, the newly deeded entity is completely legally exposed. Think about it. The personal policy insures you, not the company that now legally owns the property. If those names do not match flawlessly, any claims you file can and absolutely will be denied. That structural misalignment creates a massive vulnerability. Let me really reinforce this strict cause and effect relationship because it's a game changer. Failure to update property insurance to the LLC's name literally gives the insurer the legal right to completely deny your claims. If you go through the trouble to build a legal fortress by transferring the deed, but then fail to systematically update your coverage to a commercial policy in the LLC's name, that structural protection is instantly neutralized the second property damage occurs. The legal alignment must be absolute. The name on the deed must be the exact name on the policy, period. All right, Section 3, the architecture of transfer. Let's do a quick comparative analysis of the specific legal instruments used to physically move the asset. You fundamentally have two legal instruments to choose from here. First, there's a quitclaim deed. This one is highly efficient, super low procedural complexity. It's perfect for rapid internal moves, like transferring a property you own outright into a single-member LLC. But keep in mind, it offers zero guarantees beyond your current ownership status. It basically just says, whatever I own, I'm transferring to the LLC. On the flip side, warranty deeds are functionally mandatory for structurally complex, multi-member, or mortgage transfers. They legally guarantee a clear, unencumbered title, which means they verify there are no hidden liens, no back taxes, no competing ownership claims. Applying the wrong instrument for your specific use case, that creates systemic legal flaws right from day one. Okay, so once you select the right instrument, the execution requires really precise micromechanics. You have to draft the specific deed with absolute legal precision, execute the signatures, and get it formally notarized. But Step 3 is where the entire system frequently breaks down for novices. You absolutely must record the finalized deed at the county recorder's office. A failure to record means the public hasn't been legally notified, which leaves your transfer legally incomplete and vulnerable. Recording it is the definitive act that updates the chain of title for the entire world to recognize. We also need to clear up a massive operational misconception. Deeding property into an LLC does not magically eliminate your taxes. For a single-member transfer, the LLC is typically treated as a disregarded entity, which just means it generates no new federal income taxes. The IRS basically looks right through the LLC straight to your personal tax return. But a multi-member transfer, that is vastly different. It can trigger potential gift tax accounting, requires complex agreement updates, and completely changes how the entity files its returns. And remember, regardless of the structure you choose, local county transfer fees are going to apply universally across the board. You are simply changing the legal container here, folks, not evaporating your tax obligations. Finally, Section 4, preserving the corporate veil. Deeding the property is really just the setup. Now we have to analyze the rigorous behavioral requirements you need to maintain these legal protections. Which brings us to a really uncomfortable question, a critical vulnerability. How does an investor unintentionally destroy their own legal fortress? Because you could build the perfect LLC structure, file the perfect deed, and still systematically neutralize your own protection through simple, ongoing operational negligence. The structure only works if you respect its boundaries. The legal mechanism for that destruction is called piercing the corporate veil, and it's exactly as bad as it sounds. This is a judicial decision to completely ignore your limited liability status. If a court takes a look at your operations and decides you aren't actually treating the LLC as a distinct, separate legal reality, they will just bypass the entity entirely. Judges do not like legal fictions that are just shams.
If that veil gets pierced by a judge, the liabilities of the business suddenly become your direct personal liabilities. The hermetic seal is completely shattered. So, to prevent this, you are bound by strict, non-negotiable operational mandates. You have to establish completely distinct business bank accounts using the entity's tax ID. You absolutely cannot commingle personal and business capital. Seriously, paying for your personal groceries out of the LLC account or paying LLC repair bills from your personal checking account is a fatal error. Maintaining meticulous, independent financial documentation and executing all contracts strictly in the entity's name is directly linked to your continued lawsuit immunity. Every single receipt, invoice, and lease must respect that separation.
Now, let's flip a very common assumption right on its head. The implicit assumption out there is that an LLC provides blanket, invincible immunity against all potential lawsuits. But the legal reality? It's entirely different. While an LLC effectively shields you against external property incidents, like, say, a tenant tripping on a loose staircase, it provides absolute zero protection against your own direct negligent actions. If you personally perform a faulty electrical repair that causes a fire, or if you knowingly ignore a severe safety hazard, courts are going to hold you directly, personally liable, regardless of that LLC.
An LLC simply won't save you from personal negligence. It's literally like locking your front door but leaving the windows wide open. Structural legal shielding absolutely must be paired with severe operational caution. If your personal actions bypass the entity's protections because you acted recklessly, you're structurally compromised from the inside out. That legal architecture can only shield you from external forces, not from your own direct mistakes.
So, what's the big takeaway from all this analysis? Executing the deed to the LLC is really merely the initial setup phase. It just draws the boundary lines. True asset protection demands flawless structural architecture combined with disciplined, ongoing maintenance. The mechanism of protection only survives if your daily operational behavior continuously supports its existence. This is not a set-it-and-forget-it strategy. It is a permanent behavioral shift. I want to leave you with this final thought so you can audit your own setup. Is your property truly shielded, or is your corporate veil already legally compromised? Have you just filed the paperwork, or are your daily administrative habits actually preserving your legal fortress? Thanks for joining me on this explainer. Until next time, keep analyzing the structures that protect you.